Yes. So let's start today's class. Good morning, everybody. If you remember in the last class, what did we do? In the last class, we were doing this chapter called Ethics and Acceptance, right? We completed chapter 3, Corporate Governance, and we moved on to chapter 4, which is Ethics and Acceptance. Under chapter 4, Ethics and Acceptance, we had seen fundamental principles of ethics. What did I tell you about ethics and acceptance? Let me share my screen also so that you also get reminded of what all have you already studied. 1 second. Yes. So under this chapter, under ethics and acceptance, we had seen first what are the sources of ethics. We said ACCA Code of Ethics and Conduct and IESBA, International Ethics Standards Board for Accountants. These are the two sources for ethics. Then we said in this particular chapter, we're going to study three things. One is fundamental principles. The first one is fundamental principles. As we discussed, there are 5 fundamental principles. What was the acronym that I gave you to remember these? Do you remember? Does anybody remember, or did anybody note it down? What was the acronym for the fundamental principles of ethics? What did I tell you? What was the acronym to remember all the 5 of them? The 5 fundamental principles of ethics? Nobody? I hope at least some of you remember. Yes, good, Bhumika. IP Corp, right? I told you to remember IP Corp, where I is integrity, P is professional competence and due care, C is confidentiality, O is objectivity, and P is professional behavior. Correct? So IPCOP, IP Corp. These are the 5 fundamental principles of ethics. These are the 5 fundamental principles of ethics. IP Corp, remember them. Now, this is where we stopped, right? In the last class. Can anybody confirm? This is where we stopped in the last class, where we saw these IP Corp. We saw confidentiality in detail, and that is where we stopped. Correct? Now, moving forward, we are going to see what are the threats to these principles, especially to integrity, especially to objectivity. We are going to see what are some threats. What are some threats to these principles? So as this chapter contains, as I told you, 3 things, right? Principles, threats, and safeguards. Okay, so let us go to that part of the chapter. See, threats and safeguards. So what should the auditor do, or what should the member do? The member or the auditor or the practitioner, he should first assess, or he should first identify, before assessing, he should identify what kind of threats are there to his fundamental principles of ethics. What is a threat is there to the in this particular audit, in this particular engagement? What are the threats to his principles? For example, I told you, right? ABC Private Limited, where your wife is a director, ABC Private Limited, where your wife is a director, and if ABC Private Limited is offering you an audit engagement, ABC Private Limited is asking you to do their audit. Let's say you are an ACCA. Let's say you qualified your ACCA exams, you became an ACCA, and then ABC Private Limited is asking you to do their audit. Now, when ABC Private Limited is asking you to do their audit, can you do their audit? Should you accept that audit? In that case, there's a threat to your objectivity, right? Why is a threat to your objectivity? Because your wife is a director in that company. So there's a threat to your objectivity. You will not be independent in this case. You will be influenced. What was objectivity? Objectivity was a state of mind where you're not getting influenced by anything, right? Where your decisions are not being influenced. You're not being biased. That was objectivity. You have to be that, right? Every practitioner has to follow those principles. You have to be objective in your engagements. You have to be independent in your engagements. But this particular situation where your wife is the director in ABC Private Limited, you as an auditor will not be independent. There's a threat to your objectivity. So for this threat that you've identified, right? You've identified this threat. You will assess this threat. You will assess this threat and see how significant is it. This is a very significant threat, right? Your wife being the director there is definitely a significant threat. So this threat, which is significant to you, you will apply a safeguard. To every threat that you've identified and assessed, you will apply a safeguard. What is the safeguard here? Here, the only possible safeguard is to not accept that engagement. Sometimes the only possible safeguard is what? Is to not accept that engagement, is not to do that engagement, decline that engagement, or resign from that engagement. Sometimes that's the only possible safeguard. That's the only possible safeguard. These safeguards either eliminate the threat completely or reduce the threat to an acceptable level. The safeguards that you will apply, in our case, the safeguard is to not to accept the engagement. That's the only safeguard. Decline the engagement. This safeguard, every safeguard that you're applying to this threat, it will either eliminate the threat completely or it will reduce the threat to an acceptable level. All right. Is this clear? Is this introduction to threats and safeguards clear? Can we go and see some examples? Can we go and see some types of threats, different types of threats that can occur? Yes? Okay. Now, let's see what are the different kinds of threats that can occur in your engagement. And we'll discuss each one of them in detail. One second, let me zoom in. So threats to objectivity, we're going to see what are the threats to your objectivity, or what are the threats to your independence. As I told you in the last class, independence and objectivity are similar terms, right? They're sometimes used as synonyms. They're used in place of one another. So what are the threats to your independence, or what are your threats to your objectivity? There are 5 types of threats, and you have to remember these 5 types. There are 5 types, and you have to remember these 5 types: self-interest, self-review, familiarity, intimidation, advocacy. Self-interest, self-review, familiarity, intimidation, and advocacy. These are the types of threats: self-interest threat, self-review threat, familiarity threat, intimidation threat, and advocacy threat. Now, let us understand each one of them with the help of some examples. Let's do that. One second. Let me zoom in so that it's visible to you. Yes. See, is it visible now? Is it clearly visible now? Yes. So the first type of threat to your objectivity, threat to your independence, is self-interest threat. What do you mean by self-interest? You have some own interest in that particular client, in that particular company. What do you mean by self-interest? You have some own interest in that particular company. You have some self-interest in that company. So of course, you will not be independent then, right? If you have some own interest in that company, if you have some self-interest in that company, you will not be independent then. That is why this is a threat, a self-interest threat, where you have your own interest in that company, because of which you will be biased. Because of which you will be biased, you will be influenced, correct? But you have to be independent in all the engagements. That's a principle. So that is why this is a threat to your fundamental principles of ethics. Let's see some examples where self-interest threat occurs. Own shares. What do you mean by own shares? Let's say there's a company, let's say Reliance Industries Limited. Let's say you are owning some shares in Reliance Industries Limited. That means you are a shareholder of Reliance Industries Limited. Let us say, for example, that you are the shareholder of Reliance Industries Limited. And now, after becoming ACCA, you got the opportunity, or you got an offer, or you got a tender of doing the audit of Reliance Industries Limited. After becoming ACCA, you got an audit of Reliance Industries Limited, and you still are the shareholder of Reliance Industries Limited. You're still owning some shares in that company. Now, if you're owning some shares in that company, can you become the auditor of that company? Think. Auditor has to be independent, right? Auditor has to follow all the fundamental principles. He has to be objective. Now, if he's the shareholder in that company, will you be independent? Will you be independent or will you be biased? Don't you think you'll be biased if you're the shareholder of that company? What will you do? If the company is showing greater profits, if the company, let's say, has done some fraud or error, there are misstatements in the financial statements, and there are greater profits being shown. There are higher amounts of profits which is being shown in the financial statements. What will you do? You will be happy with that, right? It is beneficial for you. Since you are the shareholder, it's beneficial for you if the company is showing greater profits, because then you will be getting greater dividends. So your decision making while auditing will be biased. It will be influenced by such things because you are the shareholder in that company. That is why there's a self-interest threat. There's a threat to your principles, to your ethical principles. There's a threat to your independence. So what should you do then in this case? What will be your safeguard? You tell me. In this case, where you're owning the shares of a company, you're owning the shares of Reliance Industries Limited, what will be the appropriate safeguard? Don't tell me don't accept the audit. That's the last resort. If no safeguard, if nothing else is possible, then you will go to not accepting that audit. You want to accept that audit. So what should you do? What is the appropriate safeguard here? You want to do the audit of Reliance Industries Limited, then what is the appropriate safeguard? What should you do? What do you think? Think. What will be the appropriate safeguard? Nobody? It's an easy question. I thought at least a few of you would answer. Shashanka says selling the shares. Anybody else? Anybody else agrees with Shashanka? Anybody else agrees with Shashanka that selling the shares should be the appropriate safeguard here? Yes, Shashanka is absolutely right. What is the safeguard here? The safeguard here is to sell those shares. You are the shareholder in Reliance Industries Limited. Because you are the shareholder, you are not independent, you are being biased. So what can you do? Before accepting the engagement, sell the shares. Before accepting that audit, before accepting this work, sell the shares first. If you sell the shares, then you will no longer be a shareholder. So then there'll be no threat. If you're no longer the shareholder, there will be no threat, right? There will be no self-interest threat. So sell the shares. So first one is own shares. Similarly, let's get to second one, fee dependency. And for every threat that we are seeing, there will be a safeguard, guys. So for own shares, the safeguard is to sell the shares. Fee dependency. Now, what is fee dependency? Listen very carefully. Let's say you are an ACCA. Let's say you are an ACCA. And let's say you have 5 clients. For example, let's suppose that you have 5 clients. Among these 5 clients, there's one client, let's say Atlas Private Limited. This one client, which is Atlas Private Limited, this one client is, let's say, giving you a revenue of 60%. The total revenue that you're getting from 5 clients, the total revenue that you're getting from all the 5 clients, from one client itself, you're getting 60% of your fees. All of these 5 clients are going to pay you audit fees, right? If you are the auditor for these 5 clients are going to pay you audit fees. So the total audit fees that you're calculating from all the 5 clients, 60% of that is coming from Atlas Private Limited. So don't you think if 60% of your revenue, 60% of your fees is coming from Atlas Private Limited or from one company, don't you think you'll be dependent on that company for fees? You will be what? You will be dependent on Atlas Private Limited for fees. You'll be dependent on that company because that company is paying you. Because Atlas Private Limited is paying you 60% of your fees. Right? So right now, if the fees is 10 lakhs, let's say total income, to your total income from audit is 10 lakhs from 5 clients. 6 lakhs out of that is coming from Atlas Private Limited. If Atlas Private Limited, if you lose that client, if you lose Atlas Private Limited, the total revenue will fall to 4 lakhs. From 10 lakhs that you were earning, you will fall down to 4 lakhs if Atlas Private Limited does not, if Atlas Private Limited is not anymore your client, then the total revenue of your particular, total audit fees that you're earning will fall from 10 lakhs to 4 lakhs. So don't you think you are dependent on them? You'll be scared, you'll be intimidated by them. Why? Because even if they do something wrong, probably even if they do something wrong, if Atlas Private Limited does something wrong, there might be a possibility that you might not, point out that error. You might not point out that fraud. You may say that the financial statements are free from material misstatements. Even if you know that financial statements contain some frauds and errors. And why are you doing that? Because you want to be in good books of that management. You want to be in the good books of that management. You don't want to lose this client. That is why all their frauds, all their errors, you're ignoring. All of their frauds and errors you're ignoring because most of your revenue is coming from them. You don't want to lose the client. So you will listen to the management basically. You will be influenced by them. You will not remain independent. You will not remain objective because most of your income is coming from this particular client only. So that is fee dependency. So what should you do? You tell me what will be the appropriate safeguard in this case. If Atlas Private Limited is giving me 60% of my revenue, what should be the appropriate safeguard? What should I do in order to make sure that that Atlas Private Limited is not the only one company which is giving me such large revenue? What should I do? What should be the appropriate safeguard? Think. What should be the appropriate safeguard, guys? Are you guys here? Are you guys here? Ria, are you here? Ria S. Matthew. Ria S. Matthew, are you here? Can you unmute yourself? Whoever is listening to me right now, just type yes in the chat box. Whoever is listening to me right now, just type yes in the chat box. Okay, you're not able to unmute. So there are these many people in the class right now then. Nobody understood what are we discussing? Nobody understood what is fee dependency? If you understood what is fee dependency, you can give me the safeguard, I'm sure. If you understood fee dependency, I'm sure you can give me safeguard. Ria, you're not able to unmute? Okay. If you understood fee dependency, that one particular client, there are 5 clients of yours, you became an ACCA, and after becoming an ACCA, you had 5 clients. One particular client is giving you 60% of your fees. That is why you're dependent on them. That is why you're not being independent. That is why you are being influenced by them, because they are giving you 60% of your total fees. So what should you do? In order to reduce the dependency on Atlas Private Limited, what should you do? You as an ACCA should try to increase your clientele base. You should try to get more client, and you should try to get more revenue from other clients. Correct? Then that 60% will get reduced. What should be the safeguard? The safeguard should be to try to increase the other clientele base. From 5 clients, increase the clients to 15 clients. Then your revenue will also increase, and the portion that is coming from Atlas Private Limited, that proportion will reduce, because your other revenue from other clients, that is going to increase. The clients from the audit fees from other clients, that is going to increase, because you are going to increase the number of clients. So that is why the dependency on Atlas Private Limited will reduce. So that can be the safeguard. So this can be the safeguard where in order to reduce the fee dependency. Okay, that was fee dependency. Next, let's come to next point, gifts and hospitality. For example, let's say you became an ACCA, you're doing the audit of Atlas Private Limited, and the director of Atlas Private Limited is giving you a free trip to Maldives. To the people in your audit team, let's say there are 5 people in audit team. To these 5 people, the directors of Atlas Private Limited, the directors of this client, is giving a free trip to everybody in the audit team to Maldives. Should they accept that trip? Should they accept that gift? You, as an auditor, you in the audit team, should you accept such gift which is being given by the management of the company or by the directors of the company? Should you accept that gift? No? Okay, why no? What would happen? Why do you think you should not accept that trip? What is the reason? Why should you not accept such gifts from the directors of the company, from the management of the client, from your client? Why should you not accept such gifts? What is the reason? Mustaqim says it will cloud your judgment. Okay, very good. If you accept that gift, what is the management actually trying to do? The management can probably try to influence you, right? Yes, very good, Apeksha, very good, Mustaqim. You will be obliged to them for the favor that they've provided. They're giving you this gift so that they can influence you. Why are they giving you this gift? Anybody doesn't give anything for free, right? Why are they giving you this gift? They are giving you this gift from the perspective of, or for the motive of, influencing you, right? So that they can influence your decisions. Correct? So that to make sure that you listen to them, you oblige to them to whatever they say. So that is why gifts and hospitality, you should never accept. What is the safeguard? The only safeguard is to not accept such gifts. Do not accept such gifts unless it is very trivial. What do you mean by trivial? Unless the gift is very small. Let's say the client is giving you pens or pencils. The client is giving you stationery like pens or pencils. So that is very trivial, right? It's a small amount. That's okay. Let's say you went to his place to audit and they gave you pens and pencils. That's okay. Such trivial amount gifts are okay. But unless it is trivial, you should not accept those gifts. So only if it is trivial, the ethics, the code of ethics is allowing you to accept. Otherwise, do not accept any gift or do not accept any hospitality. Next, similarly, loans. What about loans? Let's say either you as an ACCA, you are an ACCA, and let's say you have given a loan to ABC Private Limited, or ABC Private Limited has given out a loan to you and that loan is outstanding, so then you cannot be the auditor of ABC Private Limited because there's this loan outstanding. Your own interest is involved, right? If there's a loan outstanding, either the loan that you have given to the company or the company has given a loan to you and there's some amount which is outstanding, so then you will be biased. You will not be independent in that case. So what should be the safeguard here? You tell me, apply the same logics and tell me what should be the safeguard. There is already a loan which is existing. There is a loan which is existing between you and ABC Private Limited. Now you want to do the audit of ABC Private Limited. So what should be the safeguard? Should you not do the audit? Is that the safeguard? Not accepting the engagement, is that the safeguard? Yes, very good, Vandita. Apply the same logic for shares. The loan which is outstanding, you can pay that loan off. You can clear that loan. Yes, very good, Mustaqim. Correct? You can pay that loan off or you can clear that loan, and that is when there will be no loan outstanding. So that is when you will be independent. So the safeguard here is to clear that loan. Okay. Next, business and personal relationships. This is the example that we were seeing. The example of your wife being the director in that company. What is happening? There's a personal relationship. There is what? There's a personal relationship. There is some personal relationship in that company. And because of that personal relationship, you will be affected. You will be influenced. And this personal relationship can be anything. It can be a father, your father working in that company, or your son, or your daughter, or your mother, or your wife, or your relative, right? So personal relationships are also, of course, a threat to your independence, threat to your objective. Apart from personal relationships, there is business relationship. Apart from personal relationship, there's business relationship. If you have a business contract with one particular client, if you're already having a business contract of purchase or sale, let's say that company is in the manufacturing of shirts and you already have a contract of selling them cotton. You are selling them cotton for manufacturing the shirts. You already have a contract with them of a sale of cotton. So then you cannot be their auditor because you have a business relationship with them. Since you have the business relationship with that company, you cannot be the auditor of that company. Okay, next, employment with client. Next point, employment with client. What do you mean by employment with client? If you're the employee of that company, can you be the auditor of that company? You are a qualified ACCA or you are a qualified chartered accountant. And let's say you're working as an employee in Reliance Industries Limited. Can you be the auditor of Reliance Industries Limited if you are the employee of Reliance Industries Limited? Of course not. Of course not. You will not be independent in that case. So employment with client is that particular point. That if you're employed with that client, if you're employed with that particular company, then you cannot be the auditor of that company. The only possible safeguard is to not accept their engagement or to leave your employment, right? Next, overdue fees. Very interesting. What is overdue fees? Let's say for this particular client, for Atlas Private Limited, let's say you were the auditor last year also. For Atlas Private Limited, let's say you were the auditor last year also, but last year's audit fees was not paid and it is still not paid. You want to start the audit work of this year, but last year's audit fees is only not paid. The last year's audit fees is overdue. If last year's fees is overdue, then again, you have an interest. There's a self-interest in that company. So what will be the safeguard? The safeguard is do not commence work until the last year's fees is paid. Until the last year fees is paid, do not commence your audit work. Do not start your audit work. That's the safeguard. You tell the company, you tell the management of your client that they have to pay you fees and then only you will start your work. That's overdue fees. And the safeguard is Do not commence work until the overdue fees, until the last year's pending fees have been paid. Next, contingency fees. What do you mean by contingent? What do you mean by the word contingent? I'm sure you must have heard about this word earlier also. What do you mean by contingent? Okay, Mustaqim says unexpected. But is unexpected the correct word? What do you mean by contingent? You must have seen this word in your accounts, right? Contingent liabilities. What do you mean by contingent there? Contingent means nothing but something which is dependent on a future uncertain event, right? Something dependent on a future uncertain event. You don't know whether that event is going to happen or not. The happening or non-happening of that event is not certain. You're not sure whether that event itself is going to happen or not. So something which is dependent on happening or non-happening of a certain of an uncertain future event, that is nothing but contingent. So can you have your fees which is dependent, the calculation of that fees is going to depend upon a future event, the happening or non-happening of an uncertain event, which we don't know whether it will happen or not, that your audit fees should not be contingent. Basically, you should not accept any contingent fees. Do not have any contingency in your fees, right? So your fees should not be dependent upon a certain on an uncertain future event. So do not accept an engagement with contingency fees. Next, litigation with a client. Litigation with a client. That means what? You have a court case which is pending, and in that court case, who are the parties? You and that client. Let's say you have filed a case against Atlas Private Limited, or Atlas Private Limited has filed a case against you. Then in that case, till the court case is pending, you cannot be the auditor of that company. You cannot be the auditor of that particular company of Atlas Private Limited if there's a court case pending, if there's a litigation pending between you and that particular client. So all of these are examples of what kind of threat? Self-interest threat. All of these are examples of self-interest threat. Right? Okay. Next, self-review threat. Self-interest is done. Let's go to next one. Self-review threat. What do you mean by self-review? Self-review is nothing but, I'll give you one example. Let's say I conduct an exam for you. Let's say I conduct an exam for you and you write the answers for that exam. And then I tell you to correct your papers on your own. I tell you what? I'm telling you to correct your paper on your own. You're writing the exam and you are only correcting the papers for your own. Don't you think every one of you will give 50 on 50 for everyone? You're correcting it for yourself, right? Will you point out your mistakes? No, right? You will ignore your mistakes. You want to give yourself 50 out of 50. You want to give yourself maximum marks possible, right? If 52 was possible on 50, you'll possibly give you 52 also. Since there are 52 participants right now, that's why I'm saying if there are 52 people, if there are 50 marks maximum, you might probably give more than that to yourself, extra marks for handwriting. Correct? That is what? That is nothing but a self-review threat. A self-review threat, where if you're checking your own things only, if you're examining something you have done, you will not be able to find your errors. You will not be able to find your mistakes. Or even if you find errors or mistakes, you will probably ignore them. Correct? That's a self-review threat. See the examples. Accounts preparation. If you're preparing the accounts for a client, can you be the auditor also of that particular client? If you're preparing the accounts for a client, or if you're helping the client also in accounts, can you be the auditor? No. If you are only preparing that accounts, how can you examine those accounts? If you are only preparing the accounts, if you are only passing the journal entries, or if you are only helping them in ledgers, that means you are only helping them in preparing P&L and balance sheet, right? So if you are only preparing the books of accounts, how will you examine the books of accounts as an auditor? That's a self-review threat. That's a self-review threat. So whenever, remember, if you're the auditor, if you want to be the auditor of one particular client, you cannot prepare their accounts. You cannot help them also in their accounting. You as an auditor, you cannot help them also in their accounting, right? So accounts preparation. Next, internal audit. If you're the internal audit of one particular client, if you're the internal auditor, then you cannot become the external auditor. It's not possible. If you're the internal auditor of one particular client, you cannot become the external auditor. This point we will also see in internal audit chapter afterwards. Next, tax computations. You cannot help the client in computing their taxes if you are the auditor. Why can't you help the client in computing the tax? Because the amount which is computed as the tax amount, that will go as a tax expenditure in P&L, right? The amount which is calculated as the tax amount, the final amount, that will go to P&L as a tax expenditure. So you cannot compute taxes for your client, because then you'll be helping them in actually determining one of the amounts in P&L that you are going to examine. It's going to be a self-review. You are only going to examine, you are only going to see whether that tax amount is correct or not, and you are only actually computing that tax amount. So you can't review your own work, right? So that is why tax computations you shouldn't. Similarly, valuation services you shouldn't give. What is valuation services? If one particular client, let's say, it wants to revalue its plant and machinery, it wants to revalue its fixed assets. If they want to revalue their plant and machinery or revalue their fixed assets, can you be their valuation expert? Can you be the expert there who gives the valuation reports, and on basis those valuation reports, they will revalue their fixed assets in the books of accounts? No. Then you're helping them in determining amount of the fixed assets. Basis your report, basis your valuation report, they are valuing the plant and machinery in their balance sheet. So you cannot then examine your own work, right? You only help them in computing or valuing that particular amount of plant and machinery. So do not give valuation services if you're the external auditor. And last, client staff joins the audit firm. This is interesting. See, this is interesting and probably a new point. There was somebody at ABC Private Limited. Let's say you are the, let's say your audit firm is the auditor of ABC Private Limited. There was one person who was employed in ABC Private Limited, let's say as a finance, in the finance department. Now, that person who was in the finance department as an employee in ABC Private Limited, he has left, he has resigned from the job of ABC Private Limited, and now he has joined the audit team. We had a firm of audit, audit firm in which we were, one particular audit team was auditing ABC Private Limited. One person has left ABC Private Limited, one employee of ABC Private Limited has left from ABC Private Limited, and he has joined our audit firm. Now that person, can he do the audit of ABC Private Limited? That person who was earlier the employee of ABC Private Limited, now he has come in the audit firm. Can he be in the audit team of ABC Private Limited? Should you allow him to be in the audit team of ABC Private Limited? No. Of course, no, right? Why? Again, self-review threat. He was the employee, he was working there. He might be responsible somewhere in preparation of books of accounts. He was in finance department. So he will be reviewing his own work if you allow him to be there in the audit team. He will be reviewing his own work because he was the employee there earlier. Correct? he can be in the audit team of other clients, right? This audit firm will have other clients also, right? Apart from ABC Private Limited, there will be other clients also. He can be he can be in the audit team of other clients, but he cannot be the auditor in the audit team of ABC Private Limited because he was the employee there earlier. That is self-review threat. So self-interest threat, self-review threat. Next, familiarity threat. Next threat, familiarity threat. What is familiarity threat? You've become too familiar with the client. You've become very familiar with the client. If you've become very familiar with the client, what will happen? You will start to ignore their deficiencies. You will start to ignore their problems. You will probably not be able to identify the errors or frauds in that particular client because you've become too familiar with that client. That is familiarity threat. See examples. First one, long association. If you are the auditors for very long time, then there will be a familiarity threat, right? If you are the auditor from a very long time, let's say from last 7 years or from last, let's say 10 years, let's say from last 10 years, if you are only the auditor of this particular client, then there will be a familiarity threat. Let's say in the last 9 years, there were no major frauds and errors that were discovered. So what will you do? If in the last 9 years, if no major frauds and errors were discovered, what will you do? You will think that in this year also probably there will be no frauds and errors. Correct? You will think that in this year also then there will be no frauds and errors. Right? So that is why familiarity is a threat. Because then you will start to ignore things. So long association is a problem. That means from a very long time, you were only the auditor. That's a problem. Next, personal relationships. This we already discussed. Your wife being, in that particular audit, in that particular client, if you have a personal relationship, then again, you will have a familiarity threat because you're very familiar with that particular person. All right. Next, movement of staff between the firm and the client. Movement of staff between the firm and the client. That means staff, that means either the employees of the client are leaving, are resigning and coming to your firm, or people from your firm are leaving the firm and going to the client. Then again, there is familiarity threat. Again, there will be familiarity threat. And lastly, gifts and hospitality. If you accept gifts and hospitality from the client, it will also create familiarity threat apart from self-interest threat. One particular thing can create two threats also, like personal relationship is creating self-interest threat and familiarity threat. Similarly, gifts and hospitality is creating self-interest threat and familiarity threat both. One particular thing can create two threats also. Clear? Are these three types of threats clear? Can I go to the next two types? All right, let's go to the next two types. Intimidation threat and advocacy threat. What do you mean by intimidation? When can I say that I'm getting intimidated by someone? When I have a fear of someone, right? When I'm fearing someone, that's when I can say that I am intimidated by someone. So when can intimidation threat happen? When can you be, scared of that client? When are you, if you're scared of that client, then you're being influenced, right? You're not being independent. If you're being scared of that client, then you are being influenced by that client. You're probably agreeing to whatever management is saying. If you're being intimidated, see the examples. Fee dependency. Fee dependency was creating self-interest threat also. It creates an intimidation threat also. If 60% of your total fees is coming from Atlas Private Limited only, then you will be intimidated, right? You will be scared that if you lose this client, you will lose 60% of your revenue. You will lose 60% of your revenue if you lose this particular client. So that's why you're scared. Correct? So fee dependency, personal relationships. Like your father is, let's say, the finance director in that company. Then don't you think you will be intimidated by him? If your father is a finance director in the company, you will probably be intimidated by him. Correct? So that is also a problem. Next, so personal relationships. Audit partner leaves to join client. The audit partner of your firm, the audit firm has partners, right? The audit partner for that particular client, who was the audit partner, he has left the audit firm and he has joined the client. Let's say he has joined the client as a director. Then don't you think the audit team, everybody was junior to him, right? Everybody will be intimidated by him. And now he has moved to the client. So this is an intimidation threat. And lastly, litigation with client. If you have a, again, if you have what? If you have a court case pending with that client, then again, there will be an intimidation threat. There will be an intimidation threat. And last and next type, advocacy, the last type of threat, advocacy threat. What do you mean by advocacy threat? If you're being the advocate of that client, if you're representing that client, if you're being the advocate of that client, if you're representing that client, then again, there is what? There is an intimidation threat. See the examples. If you're representing that client, for example, let's say you're the external auditor of ABC Private Limited. Can you become their lawyers in the court of law? In the courts, can you become the lawyer of your client? No, you cannot represent your client. Then you will not remain independent. You will not remain unbiased. So you cannot represent your client. You cannot promote your client. You cannot negotiate on behalf of your client. All of these will create advocacy threats. All of these will create what? They will create advocacy threat. Okay. Clear? All of the 5 threats done. Clear with all of them? Now, in the next slide, I've given some examples and the possible safeguards. Just read them once and let me know if you have any doubts in any one of them. Some threats, some examples of threats, and some safeguards are written here. See them and let me know where do you have doubts. What did you not understand? See this. I give you five minutes. See these. All of them. Read all of them. Quickly. Don't waste time. Read all of them. Yes, done. Did you read all the examples of threats and the safeguards? Any doubts? Are you still studying? Are you still reading them? Oh, what is EQCR? EQCR is Engagement Quality Control Review. That we will see in the chapter where we see direction, supervision, and review. We will see that in a future chapter. You will see a chapter for direction, supervision, and review. So there we will see about EQCR. It is nothing but Engagement Quality Control Review. Contingent fee. Contingent fee is nothing but a fee. The amount of that fee is going to be dependent upon a future event. For example, let me take an example that I'm saying that the audit fees is going to be 10 lakhs if the client wins one particular court case, or the audit fees is going to be only 5 lakhs if they lose that case. So this is a contingent fees. You don't know whether the client will win that court case or lose that court case, right? It's dependent on an uncertain event, on an happening or non-happening of an event, and you don't know with certainty whether the event will happen or not. So that's an contingent fee, which is dependent on a future uncertain event. Clear, Khadija? Yes. Any other doubts? EQCR, the full form of EQCR is Engagement Quality Control Review. It's an Engagement Quality Control Review. Basically, there'll be a third party, there will be a reviewer who's going to review the work that you are doing, review the audit that you are doing. You are already, examining the client's financial statements. There will be one third party, there will be one Engagement Quality Control Reviewer who is going to review your audit, the audit that you have done, or the audit or the work that you have done, that is going to be reviewed by a third party. That is called Engagement Quality Control Review. And the person who does that is called reviewer, Engagement Quality Control Reviewer. Okay. So that we'll see in future chapter. In future chapters, it will come. Okay. All right. So if this is clear, let's move forward. So we have finished ethics part. In this chapter, I told you, right? There are two parts. There's ethics and there is acceptance also. So we still have to discuss acceptance. So let's go and discuss acceptance. What about acceptance? There are, we just have to see some issues before accepting any engagement. Before accepting any engagement, we have to see some issues. For example, let's say the example of Atlas Private Limited coming up to you and asking you if you want to be their auditor. They are asking you if you want to be the auditor of that particular company, Atlas Private Limited. So should you just say yes? Should you just say yes even before seeing anything? No. Before accepting that audit, yes, you have got an offer for audit. You've gotten an offer from ABC Private Limited to do their audit, but just don't accept their audit without seeing anything. You have to consider a lot of issues before accepting an engagement. For example, One of the issues that you already know is what? See whether there is any threat to your independence and objectivity, right? See if there is any threat to your independence or objectivity, correct? If there is threat to your independence or objectivity, like uh, let's say your father is the director in ABC Private Limited, then what should you do? Do not accept that engagement. So before accepting that engagement, you have to check certain things. You have to check certain things before accepting an engagement. All right. So if you want to check certain things before accepting that engagement, if you want to check certain things, what all things do you check? These issues you check. All the issues written here, these issues you check. Okay. Let's see one by one each issue and discuss. Let's see the first one, professional clearance. Let's start from professional clearance and we will go clockwise. We'll start from professional clearance and we will go clockwise and see each of the issue. First one, professional clearance. What do you mean by professional clearance? It means nothing but to go and speak to the previous auditor. The previous auditor who was the auditor before you, right? Last year, there might be some other auditor, right, before you. So go and speak to that previous auditor, right? Go and speak to that previous auditor and get to know more information from him. About what? About integrity of the client. You can get to know what was the reason for, for him resigning from that audit. Why was he removed or why did he resign? What is the reason of his removal? Get to know that reason. Get to know whether management has integrity or not. Is management honest? Get to know what were the issues that he discovered in the audit and what was the response of the management to such issues. So you can get to know this information from whom? From the previous auditor. That is getting a professional clearance. But for getting this professional clearance, you need the approval of the client. You need what? And all of this is explained in the study text, by the way. Each point, each one of them is explained in detail in study text. So you can definitely refer to the study text in detail. I'm just telling you what does every point mean here. So you're going to the previous auditor, you're asking these things to him as to what was his reason for removal. What were the points what were the issues which were there in the audit and how did he respond to those issues? Right? And was the management having integrity or not? Did they provide entire information and explanations to the auditor or not? Or did they hide information? So all of this information, you can ask the previous auditor. But for doing this, what do you need? You need permission of your client. You can't just go and talk to the previous auditor. No, first you have to take the permission from the client. You have to get an approval. You have to take the permission of the client. If the client says yes, then you can go to the previous auditor. The client's permission is required. Similarly, for that previous auditor also, in order to respond to us, permission of the client has to be taken by him also. Because he is governed by confidentiality, right? He was the auditor of this client. He is governed by confidentiality. For him, we are third parties. We have seen confidentiality, right? That you should not disclose information that you've received during the audit to third parties. We are third parties for him. So before disclosing anything to us, that party, that previous auditor, he also has to take permission from the client. But what if the client refuses? Let's say you went to the client for the permission to talk to the previous auditor, but the client is refusing. The client is telling, no, you cannot talk to the previous auditor. Then there is an option of not accepting this engagement. You can decline this engagement because they are not letting you talk to the previous auditor. That means there's some problem. If they're not letting you talk to the previous auditor, that means there's some problem, right? That is why probably they are not letting you talk to the previous auditor. They're not giving you that permission. So in that case, there is an option of you not accepting the engagement. Don't accept the engagement. Correct? Don't accept the engagement if you think that the client is not allowing you to talk to the previous auditor. Okay, great. That is professional clearance. Next, independence and objectivity. This we already know. We know what is independence. We know what is objectivity. Before accepting any engagement, you have to check whether you will be independent and whether you will be objective in this particular client work or not. Next, management integrity. Management integrity. You will check whether the management has integrity or not. What is the meaning of integrity? Do you remember? What is the meaning of integrity? Nobody remembers? What does integrity mean? Yes. Very good, Shashanka, Vandita, Riya. It is nothing but straightforward and honest. When can you say somebody has integrity? When he's both straightforward and honest. So you are checking whether management has integrity or not. Next, you are checking whether the client is involved in money laundering. What do you mean by money laundering? That means the client is involved in converting black money into white money or white money into black money. They're involved in some, they're not basically following the tax laws. They're involved in money laundering. Then again, you will not accept such client as an audit client. Next, resources. What do you mean by resources? Before accepting the client, you will check whether you have enough resources for this particular client or not. You're going to check whether you have enough resources for the client. What do you mean by resources? You will check whether you have sufficient human resources or not, whether you have sufficient people to do this audit. For, let's say you got an audit of Reliance Industries Limited. Do you have sufficient people? Do you have sufficient human resources in order to do this audit? Do you have sufficient money in order to do this audit? Financial resources, human resources. Do you have enough time? Time is also a resource, right? Do you have enough time in order to do this audit? So you'll check all of those things in resources. Next, risks. You will see what kind of risk is involved in this particular client. What is the risk which is involved in the audit of this client? Next, fees. You will check what is the fees involved. Does the amount of fees match to the amount of work that you're going to do? Because if you think that the fees is too low, then don't accept the audit. If you think that the work is going to be a lot and the fees is too low, then don't accept the audit. So fees is also an issue. Next, professional competence. Professional competence means what? Competency. I hope you remember. I told you. For competency, remember these three words: knowledge, skills, and experience. Are you competent enough for that particular client? For example, if you just cleared ACCA, will you be competent enough to do the audit of Reliance Industries Limited? No. You might have the knowledge because you became an ACCA, but you don't have the experience for that audit. For a big audit like Reliance Industries Limited, you don't have the experience. Correct? So see whether you are professionally competent for the audit before accepting the audit. Next, see the reputation of the client. See what is the reputation of the client. Because if the reputation of the client is bad, auditing that client might bring a bad name to your firm also. And lastly, check the preconditions for an audit. Preconditions for an audit means what? There are 3 preconditions for an audit. Basically, it is related to management's responsibility. Listen very carefully, and you can write down this point if you want to in your notes. In your notes, you can write down this point. There are 3 preconditions for an audit. What are these? Management is responsible for preparation of financial statements. Correct? You are the auditor. You are not going to prepare financial statements. Who is responsible for financial statements? The management. So management should confirm you before accepting an audit. You should take a confirmation from the management. It's a precondition that management is responsible for preparation of financial statements. Management is responsible for internal controls of the company, and management is responsible to provide information and explanations to the auditor. Management is responsible for financial statements, for internal controls, for providing information and explanations to the auditor. Remember them. These are the three preconditions for an audit. These are the three preconditions for an audit. Management is responsible for financial statements, preparation of financial statements. Management is responsible for internal controls, and management is responsible for providing the auditor information and explanations. Right? The auditor needs informations and explanations. Who is going to provide that? The management. Clear? Do you have any doubts in any of these points? Anything that you've not understood? No doubts? Okay. Then next, engagement letter. What do you mean by an engagement letter? Engagement letter is nothing but like a contract between you and the client. Between the auditor and the client, this is like a contract. It contains all the terms and conditions of the audit. It contains all the details, all the terms and conditions of the audit, this engagement letter. It's a documentary proof of the things that you've agreed with the client. For example, it will contain the fees of the audit. It will contain the scope of the audit. It will contain the scope of the audit as to what is the scope of the audit. What are we going to do in the audit? It will contain the fees of the audit. It will contain various terms and conditions of the audit. It will contain the responsibilities of the management, the responsibilities of the auditor. What is the responsibility of management? What is the responsibility of auditor? All of that will be there in engagement letter. So before starting your audit work, you and the client, both of you sign this engagement letter. You and the client, both of you sign this engagement letter where everything about the audit is written, like the scope of the audit, the responsibilities of the auditor, and the responsibilities of the management, the fees as to what is the fees amount, the reference to any legislation and standards, the reference to any law, any specific planning issues, all of them will be included. All right. So that's engagement letter. You can just read that once from the study text also. This is also about engagement letter again. Okay. So this is where we finish our chapter 4, which was ethics and acceptance. Any doubts in chapter 4? Do you have any doubts? Any doubts in the chapter? No doubts? So what we'll do now is we'll take a break before we start the next chapter. We'll take a small break and then we'll start the next chapter, and we will have the class till 12 o'clock as usual. So we will continue till 12, but we'll have a break right now. I will switch on the timer. So we'll then resume after this break. All right. So I will come back after the break. Don't go anywhere. You don't have to leave the room. You be in the room. You just can, come back once the timer ends. Yes. Are you guys back? Can we continue? All right. Thanks, Sonika. What about others? Please confirm if you're back, because I'm going to start a very important chapter, your chapter number 5, which is extremely important from the perspective of your exams and extremely important from the perspective of understanding the future chapters. Okay, thank you. So let us start our next chapter, which is chapter number 5, audit risk. Let the screen load first. Yes. So chapter number 5, audit risk, as I was telling you, that this is one of the important chapters, from the perspective of your exams and from the perspective of understanding the future chapters. Now, what about risk? What is audit risk? Audit risk, and see, here we are studying about audit risk, by the way. We are not studying about business risk. Business risk is different from audit risk. The businessman having a risk of what? Let's say the risk of competitors. Let's say the risk of competitors, or the risk of you, not adapting to the new technology, technological risk, or competitors risk, or the risk of being obsolete. All of those are business risk. We are not worried about business risk. As an auditor, we are worried about audit risk. And in this chapter also, we are going to learn about audit risk. Now, what is audit risk? Audit risk is nothing but the risk of issuing an inappropriate audit opinion. Listen very carefully. What is audit risk? It is nothing but the risk of issuing an inappropriate audit opinion. That means wrong audit opinion. What does that mean? Let's say you examined the financial statements. Let's say an auditor examined the financial statements and he gave an audit opinion. He gave a final conclusion. He gave an audit opinion in his audit report saying that the financial statements are free from material misstatements. What did he say? He examined the financial statements and then finally in his audit report, he has said that the financial statements are free from material misstatements. But after 2 months, of issuing the audit report, let's say the shareholders get to know that the financial statements are actually containing some misstatements. After 2 months of issuing audit report, the shareholders are getting to know that those financial statements actually had misstatements. That means your audit opinion, was it correct? You said in your audit opinion that the financial statements are free from material misstatements, whereas there were material misstatements in the financial statements. So your audit opinion was inappropriate. Your audit opinion was wrong. Correct? So what is audit risk? The risk of you issuing. I'm not saying you issued, I'm saying the risk. The risk that you have as an auditor of issuing a wrong audit opinion. The risk of you as an auditor issuing an inappropriate audit opinion. The risk that you issued an opinion which said that the financial statements are free from material misstatements, but actually in the financial statements, there were misstatements. You said it is free from misstatements, but in the financial statements, there were misstatements. So the risk of issuing a wrong audit opinion like that, the risk of issuing an inappropriate audit opinion like that is audit risk. Is audit risk, right? Okay. Now, this audit risk is actually dependent on 3 things. It is a function of 3 things. What are the 3 things? Let me go there. Yes. Inherent risk, control risk, and detection risk. Listen to this very carefully. Very important from your from the perspective of you understanding the future topics. Audit risk, which is nothing but the risk of issuing an inappropriate audit opinion, right? So you do a risk assessment. Before starting your audit, before actually working, before actually doing the audit procedures, you do an assessment, and this assessment is done for every client separately. This assessment of audit risk as to what kind of audit risk is involved, this assessment is done for every client separately, right? And this is done before you starting your audit procedures. You're seeing what is the risk in this client that I will issue a wrong opinion. What is the risk of me issuing a wrong opinion? That risk of you issuing your wrong opinion is broken down as a function of three things: inherent risk, control risk, and detection risk. Inherent risk, control risk, and detection risk. Before seeing these three things, I want to tell you that inherent risk and control risk put together form risk of material misstatement, RMM. I will show you that in the next flowchart. 1 second. Yes, see this flowchart. See, audit risk is at the top. Inherent risk and control risk put together is risk of material misstatement, RMM. You can copy down these flowcharts. You can copy down these flowcharts in your notes. What is risk of material misstatement? The risk that the financial statements that you're examining are materially misstated. The risk that the financial statements that you're examining, the risk that they are misstated, the risk that they contain material misstatements, that is risk of material misstatement. Only your financial statements, only the financial statements containing misstatements, only that risk will not form audit risk, right? The financial statements containing misstatements along with detection risk forms audit risk. What is detection risk? Detection risk is you as an auditor, you were unable to detect the misstatements. The misstatements were there in the financial statements, but you were unable to detect them. That is audit risk. That is audit risk. Because if there are misstatements and you detected them, listen very carefully, if there are misstatements and if you detected them, then there's no problem, right? If you detected the misstatements, then you will give a correct audit opinion. When will a wrong opinion go? When the financial statements are misstated, but the auditor failed to detect those misstatements. He couldn't detect the misstatements. Why? Probably his audit procedures were wrong. The work that he has done, the audit procedures that he has done, probably those audit procedures were wrong, right? And that is why there is a misstatement. And that is why he could not detect the misstatements. There were misstatements, but the auditor could not detect it. The auditor could not identify those misstatements. Why? Probably his audit procedures was wrong. The audit procedures that he did, those audit procedures were inappropriate. That is why he couldn't detect. All right. So audit risk, the risk of issuing a wrong opinion is based upon mainly two things: risk of material misstatement and detection risk. What is risk of material misstatement? The risk that the financial statements that you're examining might contain material misstatements. That risk, along with the risk of you not detecting those misstatements, that's detection risk. Risk of financial statements being misstated, along with the risk that you are not able to detect those misstatements, both of them put together is audit risk. And risk of material misstatement can be broken down into inherent risk and control risk. That is why we are saying that audit risk is a function of three risks: inherent risk, control risk, and detection risk. Inherent risk, control risk, and detection risk. Right? Okay. Now, what is inherent risk? What is control risk? We are saying inherent risk and control risk put together is forming risk of material misstatement. But what is inherent risk and what is control risk? Listen very carefully. Inherent risk is nothing but inherent risk is nothing but the risk that the financial statements can be misstated because of the inherent nature of the business. Because of what? Because of the inherent nature of the business itself. Probably the business itself is so complex that there's a risk that there will be errors and frauds in the financial statements. Listen very carefully. What am I saying? The risk, for example, let me take an example and then tell you. Let's say the company is involved in complex transactions. Let's say the company is involved in what? Is involved in complex transactions. They're doing very complex transactions. If the company is involved in complex transactions, then don't you think the accounting treatment of that also is going to be complex? If the company is involved in complex transactions, the transactions that they're doing are very complex. So the accounting of that is also going to be very complex. If the accounting of something is very complex, is very difficult, don't you think there is a higher risk of errors occurring? If the accounting treatment is complex, if it's difficult, the risk of errors occurring, the risk of misstatements occurring is higher, right? Right? Correct? The risk is higher there because the accounting treatment itself is complex. There's a higher risk that there will be misstatements. There's a higher risk that there will be errors. That is inherent risk. It is inherently there. It is naturally there. It is the inherent nature of the business. Correct? So even before considering the internal controls, the risk which is present, that is called inherent risk. That is because of the nature of the business. That is because of the things which are naturally occurring. Right? And this is not in anybody's hands. Inherent risk is not in anybody's hands. The management of the company also, they cannot reduce inherent risk because it is naturally occurring. It is there. It is present naturally, inherently. All right. So see, inherent risk, read there. The susceptibility of a balance to misstatement. The susceptibility means what? The chance that the balance is misstated before considering the internal controls, before consideration of controls. Basically, the risk that the financial statements are misstated even before considering internal controls. That is inherent risk. The risk that the financial statements are misstated even before considering internal controls. You can write down in your notes. In your notes, you can write for inherent risk, the risk that the financial statements are misstated even before considering internal controls. The risk that the financial statements are misstated even before considering internal controls. Even before considering internal controls. Right? That is, you can write, you can continue. That is I dot E dot due to the inherent nature of the business. That is due to the inherent nature of the business. That is due to the inherent nature of the business. Done? See the examples there. Higher risk will be there, higher inherent risk will be there if the client is in a volatile industry. If the industry in which the client is there, if that industry is volatile, that means if the industry is volatile means what? If it keeps changing. If that industry regularly keeps changing, then of course there will be more risk that there will be more risk, right? That your accounting can have more errors. Your accounting might have more errors because the industry itself is volatile. It's changing. The industry itself is not being constant. So if the client is in a volatile industry, then there is a higher possibility, there's a higher risk that the financial statements might be misstated. Okay, next, engaging in foreign transactions. That means what? That means the transactions are going to happen in a foreign currency, but you have to account in the Indian currency. Correct? Next, rapidly changing technology. If the technology is rapidly changing, if it is continuously changing, then again there will be a higher risk that your particular, your particular uh, accounting can be having errors. So that is inherent risk. Inherently, it is present due to the nature of business, due to the nature of transactions, due to the nature of industry, due to the kind of transactions that you're entering into. All right. Next, control risk. Let's go to next risk, control risk. What is control risk? The risk that the client's internal controls are failing. The risk that the client's internal controls are failing. What do you mean by internal controls? Does anybody know what are internal controls? Anybody knows what are internal controls? Internal controls. Never heard about it? Okay. Internal controls are nothing but, okay, one answer I have. 1 second. Okay, Mustaqim says controls within the organization. That's true. Internal controls are controls within the organization. But what do they mean? What are they? They are nothing but policies and procedures which are in place. Internal controls are the policies and the procedures which are in place in the company, which are trying to detect, prevent, and correct the frauds and errors. Listen very carefully. They are what? They are nothing but the policies and procedures which are in place, which are trying to prevent, detect, and correct the frauds and errors. They're trying to prevent errors. They're trying to prevent frauds. They're making sure that the frauds don't occur. They're making sure that the errors don't happen. And if the frauds and errors have happened, they're making sure that those frauds and errors are getting detected. They're getting corrected. Right? Okay. So let me give you an example of internal control so that you understand. Let me give you an example. Let's suppose there's a clothing store. Give me an example of a clothing store which is big. Let's say Max showroom or your Shoppers Stop or Lifestyle. Any of these clothing stores, let us take the example of Max. So let's say in the Max showroom, there'll be multiple billing desks, right? There'll be in Max showroom, there'll be multiple billing desks. Now at that billing desk, at that billing kiosk, there will be a person who will do what? Who will take the clothes that the customer has liked and he'll make the invoice for those clothes. He will give the invoice to that customer and collect cash from that customer. Correct? He will, that person at the billing desk in the Max showroom, what is he doing? He's taking the clothes from the customer that he liked. He's making invoice for those goods. He's giving that clothes back. He's giving the invoice and he's taking the payment from that customer. Now, this person who's taking payment from the customer, let's say he's responsible for taking the payment. He's also responsible for keeping that cash safely for the custody of the cash. He's responsible for collecting cash. He's responsible for keeping that cash safely. He's responsible for the safe custody of the cash. He's also responsible for recording of that cash in the books of accounts. The journal entry of this receipt of cash, he's also responsible for that. He's also responsible for recording of that cash in the books of accounts. So what is he responsible for? he's actually responsible for three things right now. He's responsible for collecting the cash. He's responsible for keeping the cash safely, for the custody of the cash, and he's responsible for also recording of that cash in the books of accounts. Now, if the same person is responsible for three things like these, what can happen? What issue can happen? There might be a situation that that person will collect cash from the customer, and what will he do? He will steal that cash. He will put that cash in his own pockets, and he will not record any journal entry. What is happening? He is doing a fraud. The Max showroom had told him to be responsible for three things. He was responsible for collecting the cash, for keeping the cash safely in a safe custody, and for recording of that cash in the books of accounts. But what did he do? He can do what? He can collect the cash from the customer and put it in his own pockets. He can put that cash in his own pockets, and he will not record any journal entry. He will not record any journal entry in the books of accounts. Correct? So in order to avoid this, what can the company do? In order to make sure that this person, this salesman, is not doing this, in order to make sure that he does not steal the cash, what can the management do? What can Max showroom do? They can segregate the duties. Listen very carefully. What can they do? They can segregate the duties. Rather than only one person being responsible, they can have three different employees doing this job. One employee will be responsible for collecting the cash from the customer, and another employee will be responsible for safe custody of the cash, and another employee will be responsible for recording of that cash in the books of accounts. So now this single person cannot do fraud, right? Correct? So this segregation of duties is preventing frauds from occurring. This segregation of duties is preventing frauds or errors from occurring because they have segregated the duties between three people. Rather than only one person doing the job, now three people are doing the same job. I'm not saying that, so this segregation of duty is preventing fraud, but I'm not saying that fraud is impossible to occur. No, still frauds can occur. How can they occur? If all three of them collude, if all three of them come together. If all three of them come together, if all three of them collude, then frauds can still occur, right? So I'm not saying that it's impossible for the frauds to occur, but still it's difficult now, right? Earlier it was easy, but now it's difficult. For all of three of them to collude is not easy, right? Every person's thinking should match. Correct? So segregation of duties is an internal control. It is preventing errors from happening. If the error has happened, it will detect the error. It is preventing fraud from happening. Or if the fraud has happened, it will detect the fraud because of segregation of duties. So segregation of duties is one of the internal controls. Similarly, let me give you another example. And I'm giving you these examples because you have to remember these. Internal controls is a completely different chapter. Internal controls is a completely different chapter. So we have to remember internal controls and we have to discuss that in detail. So remember these two examples and let's discuss the second example. The second example is authorization. The second example is authorization. What do you mean by authorization? Let me give you an example for authorization. Let us say there are lower level employees. Let's say there are lower level employees who are preparing invoices. The lower level employee, let's say he's preparing invoice, a sales invoice. What will you put in sales invoice? You will put the description of the goods, sold. You'll put the units, how many units have been sold. Correct? You'll put the description, you'll put the units, the number of units sold. You'll put price per unit. You'll put what is the price per unit. You will get total amount. Then you will also calculate discounts and taxes, any discounts given and any taxes to be added, and then you will get the final figure. So all of this, a employee is doing. An employee is preparing the sales invoice, a lower level employee. Now this sales invoice is, let's say, there is a policy of the company that every sales invoice should be authorized by, let's say, a manager. What is the policy? The policy says that every sales invoice which the lower level employee is preparing, every sales invoice has to be authorized by, let's say, a manager. If every sales invoice is going to be authorized by the manager, if it is going to be authorized, if if it is going to be authorized means what? That means that sales invoice which the lower level employees prepared, that sales invoice will go to the manager. That manager is going to check. The manager is going to check that invoice. Is the description of the goods correct? Are the units correct? Is the total amount correct? Is the calculations correct? Is the discount and GST correct? So all of that will be checked by the manager, and then he will sign that invoice. And then he will sign that invoice. That means what? That means if the lower level employee has done any fraud or error, that will be detected by the manager, right? Every invoice has to be signed by the manager. That means if the lower level employee has done some fraud or if he has done some error, that will be detected because the manager will catch hold of that. So that is authorization. This is authorization. One senior person is authorizing those invoices. He's signing those invoices, is checking and signing those invoices. So he's preventing any frauds or errors from occurring. He's detecting frauds or errors from occurring. How is he preventing? The lower level employees know that the sales invoice is going to be checked by a senior person. So they will not do frauds. The lower level employees will not do frauds. The frauds will be prevented because they know that there's someone else who's going to check these invoices. Right? So that's how it's prevented. So remember these two internal control activities: segregation of duties and authorization. Then what is control risk? What are internal controls doing? Internal controls are trying to detect and prevent and correct your misstatements, right? The internal controls are trying to prevent, detect, and correct the misstatements. If the internal controls fail, then what will happen? If the internal controls, either the internal controls are not proper or if the internal controls are failing, proper internal controls are not present or internal controls are present but they are not operating effectively, then they will fail to detect frauds and errors. That means frauds and errors will occur. That is nothing but control risk. That is nothing but control risk. The risk that the client's internal controls are failing to prevent and detect the misstatements. The misstatements which can happen in the financial statements, those misstatements, the client's internal controls are failing to detect and prevent them, or failing to prevent and correct them. Prevent, detect, and correct them. So that is control risk. And see examples. Higher risk when there's an old software, when there's lack of segregation of duties, lack of authorization procedures. In these cases, there will be a higher risk that the financial statements are materially misstated, that the financial statement, excuse me, guys, that the financial statements contain material misstatements. If there's lack of segregation of duties or lack of authorization procedures, right? So that's control risk. So inherent risk and control risk put together. Control risk is control risk is what? Control risk is that if the internal controls of the company are not proper, listen very carefully. If the internal controls of the company are not effective, if they are not proper, then there's going to be a higher risk that your financial statements are misstated. If the internal controls of the company are not operating effectively, then there is going to be a higher risk that the financial statements are misstated. I am not saying that if there are no proper internal controls, the financial statements are definitely misstated. There's a difference in both these statements. We are not saying that if the internal controls are failing, if the internal controls are not operating effectively, the financial statements definitely has misstatements. No, we are saying if the internal controls are failing or if the internal controls are not operating effectively, we are saying there's a risk that financial statements are misstated. There is a risk that the financial statements are misstated. Clear? So risk of material misstatement, the risk that the financial statements contain misstatements, can be broken down into inherent risk and control risk. That risk of material misstatement along with detection risk forms audit risk. What is detection risk? The risk that the financial statements are misstated alone will not form audit risk, right? What is audit risk? Audit risk is risk of you issuing a wrong opinion. So if there are material misstatements and you failed to detect them, then there's a wrong opinion. So what is detection risk? The risk that the auditor fails to detect those material misstatements. There are material misstatements in the financial statements, but the auditor failed to detect them. The auditor failed to detect them. Correct? Okay. Why will the auditor fail to detect? Why will the auditor fail to detect any misstatements? Because he used some inappropriate audit procedures. Because he used some inappropriate audit procedures or he misinterpreted results. Because of that, there can be a detection risk. There can be a higher detection risk. Okay. Clear till here? Any doubts till here? Any doubts still here? Are you guys here? Is a 2 hours class too long? Sorry, 3 hours. Is a 3 hours class too long for you? Is a 3 hours class too long for you to, keep your understanding, keep your concentration on the class all the time up? Vandita says it is. I agree. It is. Bhumika also says too long. I don't know if we can do something about it. You can talk to your coordinators once to see if we can have 2-hour sessions rather than 3-hour sessions. So you can talk to your coordinators, see if it's possible to have 2-hour sessions rather than 3-hour sessions. If they are okay with that, then we can, rather than finishing it earlier, we'll have more days classes, but every day we can have 2-hour sessions. But let's see if it's if it's getting too boring, let me know. If it's getting too monotonous, if it's getting too boring, let me know. We can take a small break, or we can discuss something else, or we can do something about it. Whenever it's getting too monotonous, you can let me know. All right. So audit risk, we have seen that it contains what? It contains risk of material misstatement and detection risk. Risk of material misstatement contains inherent risk and control risk. Detection risk contains sampling risk and non-sampling risk. Right? Okay. What is sampling risk and what is non-sampling risk? What do you mean by these? Okay, listen. Let me explain that. What is sample? I told you that An auditor, a person, a practitioner who's auditing a client, he cannot check 100% of the transactions, right? An auditor who's checking the transactions, he will not be able to check 100% of transactions. Lakhs and lakhs of transactions will happen in a year. How will he able to check those lakhs and lakhs of transactions, all of them? He will not be able to check all of them. So what does he do? He selects a sample. What does the auditor do? The auditor is checking a sample of transactions. We've seen this in chapter 1 also, that an auditor does not test all the transactions. He does not have that much time. He does not have that much, it's not possible to check lakhs and lakhs of transactions which happened during the year. He does what? The auditor checks a sample of transactions. For example, let's say there are 1 lakh transactions in total, 1 lakh sales transactions. Out of the 1 lakh sales transactions, he might select how much? Let's say he's selecting 2000 transactions. How will he decide that 2000? That also we will discuss in further topics. But right now, you just imagine that there are 1 lakh transactions, 1 lakh sale transactions, out of which he's selecting 2000 transactions to test. Now, these 2000 transactions that you're selecting as a sample, they should be representative of the population. How should the sample be? The sample should be representing the entire population. If the sample is not representing the entire population, then your opinion, your conclusion might come wrong. Your conclusion might come wrong if your sample that you've chosen, that is only wrong. If the sample is not representing the entire population, then the conclusion that you're drawing on that sample, that might be wrong, because the sample that you've chosen, that itself is wrong. The sample is not representing the entire population. What does it mean? For example, let's say there's a company which is, let's say, selling soaps. It is selling shampoos also. It is selling conditioners also. It is selling face wash also. It is selling what? It is selling soaps, face washes, shampoos, and conditioners. So now in their sales, all of these 4 item sales will be included, right? There will be sales of soaps, sales of shampoos, sales of conditioners, sales of face washes. All of these 4 sales will be included in their sales amount, in the sales of the P&L. Now, when you're selecting a sample, can you select the transactions only from shampoos and soaps? Will it represent the entire population if you select the sample of transactions only from the sales of shampoo and soaps? No. You as an auditor should select transactions from all of the 4 items. You must select the transactions from all of the 4 items. Then I can say that it is representing the population. And while selecting the amounts, select certain items which are of high amounts, select certain items which are of very low amounts, select certain items which are unusual, or select the sales which contain a lot of units, high number of units have been sold in that transaction. So select those kind of transactions as sample, but select transactions from all of the 4 products. Some from soaps, some from shampoos, some from conditioner, some from face wash. If you select only from 2 of the products or 3 of the products, then that sample will not represent the entire population. That sample will be wrong. And what is sampling risk? The risk of you selecting the wrong sample, because of which your conclusion is going to be wrong. That is sampling risk. Because you've chosen a wrong sample, because your sample does not represent the entire population, because of such wrong selection of sample, what is happening? Because you selected a wrong sample, the conclusion that you're coming up to, that conclusion itself is wrong. That is sampling risk. That is sampling risk. So let's read about sampling risk. It's given in the next page. Come here. See, sampling risk. What is it? Sampling risk arises from the possibility that the auditor's conclusion based on a sample may be different from the conclusion reached if the entire population was subjected to the same procedure, right? It is the possibility that your conclusion, the conclusion that you're drawing based on the sample of transactions, that conclusion may be different from the conclusion if you have reached, if the word if is there, if the entire population was subject to the same audit procedure. If that is different, if the conclusions might be different, then there's a sampling risk, right? Then there's a risk that you are giving a wrong opinion. There's a risk that you are giving wrong opinion. Then what is non-sampling risk? Then what is non-sampling risk? Non-sampling risk is the risk that auditor is reaching to an inappropriate opinion in spite of choosing the correct sample. What happened? In spite of you choosing the correct sample, you went on to give a wrong opinion. Because of what? Probably your audit procedure was wrong. Probably your audit procedure was wrong. The sample was correct. You've chosen a representative sample. The sample was representing the population, but still the audit opinion was wrong or the conclusion was wrong. Why? Because your procedure, audit procedures were wrong. Inappropriate audit procedures. That is non-sampling risk. So sampling risk is due to wrong sample, the sample not representing the population. Non-sampling risk is because of inappropriate audit procedures, where your audit procedure itself is not correct, inappropriate. Okay. All right. Now, we've understood what is inherent risk. We've understood what is control risk. We've understood what is detection risk. But what is their significance? Why are we studying them? Or how is it important to an auditor? For an auditor, why are they important? Why is inherent risk, control risk, or detection risk important for an auditor? Why is he looking at these risks? Listen very carefully. You tell me, what risks can auditor influence? If you are the auditor, which risks can you change? Inherent risk, control risk, detection risk. Which risks are in your hand? Which risks can you influence? Which risk can you influence as an auditor? Try to guess. It's okay if you're wrong. It's okay if you're wrong. Try to guess. As an auditor, which risk you might influence? Mustaqim says detection. Vandita says control and detection both. Debanshu says control and detection. Shashanka says only detection. Okay. So you people are getting confused about control risk. Does everybody agree that detection risk, of course, you can influence, right? You can change detection risk, of course. You can, as an auditor, you can, of course, change detection risk. That is there in your hands. By choosing the correct sample, by using the appropriate procedures, you can definitely change the detection risk. What about control risk? Is control risk in your hands? Is control risk in your hands? Can you increase or decrease the control risk? Is it possible to do that? Can you increase or decrease control risk? Is it possible to do that? Control risk. What is control risk? The risk that the client's internal controls are failing. Now, internal controls, are you responsible for internal controls or the client? Is the management responsible for internal controls, or is auditor responsible for internal controls? The management is responsible, right? As an auditor, you can only assess control risk. You can only check how much control risk is involved in that client, but you cannot change control risk, right? Can you go and change the internal controls of the client? How will you increase or decrease control risk? if you want to decrease the control risk, there should be strong internal controls. If you want to decrease the control risk, there should be what? There should be strong internal controls. If there are weak internal controls, the control risk is going to be high. So if you want the control risk to be lower, you need strong internal controls. You as an auditor, can you go and change the internal controls of your client? No, you don't have that authority. It's not your responsibility. You don't have that authority, or you don't have that responsibility. The management has that responsibility. So who can change or influence control risk? The management, not the auditor. Who can influence the control risk? The management can influence the control risk. Auditor cannot. The auditor cannot. Auditor cannot change, cannot influence the control risk. What about inherent risk? What about inherent risk? Of course, again, auditor cannot. Auditor cannot. Client also cannot. The management also cannot influence inherent risk, because that is inherently there. It is because of the complex transactions. Can you say that because the accounting is difficult, you will stop the transactions? Only because you think that the accounting is going to be difficult, will you stop the complex transactions? No. So inherent risk, nobody can influence. Control risk can be influenced by management. It can be changed by management. It can be increased or decreased by management. Detection risk is, of course, can be changed by the auditor. Okay. If you know this much, now we can understand the next level of understanding. What is the significance of these? To an auditor, how is this helping? Listen very carefully. What will the auditor do? The auditor will assess. The auditor will assess, he will do an assessment of whether inherent, of how, what is the level of inherent and control risk involved in the client. For one particular client, they will assess how much of inherent risk and control risk is involved. If they saw that the internal controls of the company are weak, if they saw that the internal controls of the company are weak, then that means what? That means the control risk is going to be high for that client. The control risk is going to be high for that client. As an auditor, what do you want to do? As an auditor, you want to keep your audit risk the lowest, right? As an auditor, you want to keep your audit risk lowest. If you want to keep your audit risk lowest, what do you have to do? You want to keep your audit risk the lowest, but you got to know that the control risk is high. You want to keep your audit risk to be the lowest. Of course, right? As an auditor, you don't want your audit risk to be high. The risk of you issuing an inappropriate opinion, you want it to be low always. So you want audit risk to be low. You assessed in this particular client, you got to know that the control risk is high. So what will you do as an auditor? As an auditor, you will try to reduce detection risk. As an auditor, you will try to reduce what? You will try to reduce the detection risk. Correct? And how will you reduce detection risk? How will you reduce the detection risk? You will reduce the detection risk by doing more audit procedures, increasing the number of transactions in the sample. How can you reduce detection risk? You can reduce detection risk by doing more audit procedures, by increasing the substantive procedures, by reducing the number of items, by increasing the sample sizes, by increasing the number of transactions in the sample, basically by increasing the sample size, by increasing the substantive procedures, by employing more experienced and more skilled people in the audit team. What can you do? You can you can have more skilled people, more experienced people in the audit team in order to reduce detection risk. You can increase review procedures, you can increase the supervision. As an auditor, you can increase supervision, you can increase the review procedures. All of that you can do in order to reduce the detection risk. Right? Why do you want to reduce the detection risk? Because you assessed that the control risk is high. You assessed, you did an assessment, and you got to know that the control risk is high. That is why you want to reduce your detection risk. Right? So that is the significance of audit risk. That is how it is going to help the auditor. The auditor is able to decide how much of audit procedures are going to be performed, how many transactions are going to be tested, what sample size should be taken, what kind of people should be involved in the audit team, what kind of review and supervision procedures should be involved. All of that is being decided because of the risk involved. Right? That's the significance of audit risk. So let's read. See the right hand side. Significance of the risk approach. Read. Inherent risk and control risk cannot be directly influenced by the auditor. Inherent risk and control risk, they cannot be directly influenced by the auditor, right? The auditor can, however, manipulate detection risk. If they assess, they is the auditor. If auditor assesses that inherent and control risk are high, that is, there is the increased risk of material misstatement. There's a higher risk that the financial statements are going to be materially misstated. They can lower the detection risk through the following means, right? If the control risk is high, the detection risk has to be lowered. And in order to lower the detection risk, what can the auditor do? Increasing substantive testing. You will increase the substantive procedures. Basically, you're increasing the audit procedures. You're increasing sample sizes. The number of transactions that you're checking, that is sample, right? You're increasing the number of transactions that you're checking. You're using more experienced staff, more skilled staff. You're increasing the level of supervision and increasing the review procedures. The supervisions you're increasing and the review procedures you're increasing. Review is nothing but check. Reviews are nothing but lower staff work will be checked by the senior person. That's review. And lastly, by performing a more thorough audit, there is less risk that the auditor fails to detect material misstatement. Clear? Understood why inherent risk, control risk, and detection risk are important to an auditor? What does he do with these? These are helping him to determine the way forward of the audit, as to who should be in the audit team, what kind of sample should be selected, how much supervision and reviews involved. So it is giving him the way forward of how to do his audit. Is it clear? Are you guys here? Or did you guys go away? Clear? Okay. Thank you, Mehul. All right. Now, let's go to the next topic, which is materiality. Let's go to the next topic and discuss as to what is materiality. And we will probably, 1 second, how much is left? Yes, we will probably end the class by understanding materiality. We will understand what is materiality and then we will end the class. Do you remember what is a misstatement? Did we discuss what is a misstatement? Did we discuss already what is a misstatement? When I say that the financial statements, whether as an auditor, you're checking whether the financial statements are materially misstated or not, or whether the financial statements contain material misstatements or not. What is that misstatement? What does that word mean? What does that word misstatement mean? Anybody? Okay, Apeksha says error. Anybody else? What does that word misstatement mean? Okay, listen. Misstatement can happen due to error or fraud. Listen carefully. It's an important concept again. Misstatement, because this word you must have seen a lot of times, right? Let us try to define that word. Misstatements can happen due to error or fraud. But what is a misstatement actually? What do you mean by the word misstatement? Misstatement means nothing but the amount or the item which is reported in the financial statement. Listen very carefully. The item which is reported in the financial statement, the item which is there in the balance sheet or P&L, if it is not matching with the accounting standard, then there's a misstatement. For example, let's say in the fixed assets of a company, some item is included which should have been expensed out as repairs and maintenance. That amount was actually repairs and maintenance, but they have included that in fixed assets. If it's repairs and maintenance, what does the accounting standard say? Accounting standards tells you to put that to P&L account as an expenditure. But what did the company do? The company has added that amount in the fixed assets amount. The repairs and maintenance, what did the company do? The repairs and maintenance, the company has added the amount of repairs and maintenance in the fixed assets account. So what did they do? They overstated the amount of fixed assets. Correct? They increased the amount of fixed assets, and it is not as per the accounting standards. The amount which is reported, that amount is different from the amount which should have been reported as per the accounting standards. As per the accounting standards, the amount should not have been included. Correct? As per the accounting standards, the amount should not have been included in the fixed assets, but they included it. That is nothing but a misstatement. That is nothing but a misstatement. Now, this can either happen due to error or fraud. What is error? What is fraud? If it is intentionally done, it is fraud. If it is unintentionally done, it's an error. If something is intentionally done, it is fraud. If something is unintentionally done, it is an error. So look at the right hand side. Okay, before looking at the definition, can the misstatement only happen in the amount? Can the misstatement only happen in the amount? No, it can happen in amount. The amount might not be matching as per accounting standard, or presentation or classification might not match as per accounting standard. What do you mean by presentation or classification? For example, rent for office building. Rent for your office building. Can you take that rent for office building to cost of sales? Can you include that in cost of goods sold? In order to calculate gross profit, in the P&L, you have revenue minus cost of sales, you get gross profit. Then from that, you reduce general administrative expenses, marketing expenses, selling expenses. Then you get profit before taxes. So can you reduce your rent of office building from, can you include that? Can you include the rent of office building in cost of sales? Is it cost of goods sold? No, right? That will be a wrong classification. Rent of office building should be included in general and administrative expenses below gross profit. The rent for office building should be included below gross profit in the general and admin expenses. If you're including in cost of sales, then again there's a wrong presentation and classification which is not matching as per accounting standards. So that will be a misstatement. So misstatement can happen in amount, it can happen in presentation or classification, or it can happen in disclosures. In the notes to accounts, you're disclosing a lot of things, right? In the explanatory notes, there are a lot of disclosures that you put. Those disclosures also, if they are not matching as per accounting standard, there's a misstatement. So read.
Read what's a misstatement. Misstatement, a difference between a reported financial item, a reported item, and the amount, classification, presentation, or disclosure that is required for the item to be in accordance with the applicable financial reporting framework. What do you mean by applicable financial reporting framework? The accounting standards applicable. Like if Ind AS is applicable, or is it that US GAAP is applicable, or is it the IFRS applicable? Which financial reporting framework is applicable? As per that financial reporting framework, the accounts are not matching. There's a difference. There's a difference between what is reported in the financial statements and what should have been reported as per the applicable financial reporting framework, as per the accounting standards. That is a misstatement. Is it clear, or do you want me to explain it once again? Did you understand misstatement, or do you want me to explain this once again? Okay. So now that you've understood misstatement, along with misstatement, we use this word material, right? We always say that as an auditor, what are you trying to see? You are trying to see whether the financial statements are containing material misstatements or not. So what are we saying? We are saying material misstatement. Now, what is material? When can you call something as material? Come back to materiality. When can you call something as material? Okay. Listen to me. Let me give you an example so that you understand, and then we can go into the definition. Listen. Let's say you wanted to invest in the shares of Reliance Industries Limited. Let's say you are the shareholder and you wanted to invest in the shares of Reliance Industries Limited. Now, if you wanted to invest in Reliance Industries shares, what will you see before investing? Before investing, you will see what is the performance of the company, what is the position of the company, what are the assets and liabilities of the company, how much profit is the company earning, what is going to be the future of that company. You will see all of these things before investing, right? Before investing, the person who's investing, the person who's buying the shares, he will see all of these things before investing, right? And all of this information is available where? From where can I know all of this information about financial position, financial performance? From the financial statements. From the financial statements of Reliance, I can get to know all of this information. So let's say I got the financial statements of Reliance Industries Limited and I was studying those financial statements. I saw the financial statements and I was happy with it. I was satisfied with their financial performance. I was satisfied with their position. So that's why I invested in those shares. After seeing the financial statements, I invested in those shares. Okay. But after investment, after 3 months, let's say you get to know that there was a misstatement in the Reliance Industries financial statements. You get to know after 3 months of investing that the financial statements that you saw, those financial statements contain misstatement. And what was the misstatement? Let's say the fixed assets amount included a repair and maintenance account of 10,000. 10,000 rupees. By 10,000 rupees, the fixed assets were overstated. By 10,000 rupees, the fixed assets were overstated. The amount was more by 10,000 because something which should have been sent as repairs and maintenance has been included as fixed asset. The fixed assets account was more by 10,000. Now 10,000 rupees in the fixed assets of crores. Reliance Industries will have fixed assets amount in crores, right? In the crores of fixed assets, a 10,000 rupees, will it affect your decision? The decision of you buying or not buying the shares, because of this error, will that change? If that error was not there, will you not buy the shares? If the fixed assets value is reducing by 10,000 because of that error, will you not buy the shares because of that 10,000 rupees? No, right? That 10,000 rupees is not going to affect your decision. Why? Because the amount of fixed assets is in crores. In that crores, that 10,000 rupees is not material. In that amount which is in crores in that fixed assets, that 10,000 is not material. That is why it does not affect your decisions. If that 10,000 error was not there also before, you would have the same decision. And with the error also, you had the same decision. Then what is materiality? If the amount was, let's say, not 10,000, but the amount was, let's say, 20 lakhs. If the amount was not 10,000, but the amount was 20 lakhs, then don't you think your decision might have changed? You took a decision basis on the fixed assets amount, which was overstated by 20 lakhs. The amount of fixed assets was more by 20 lakhs. It should have actually been lesser. By what amount? By 20 lakhs. Then probably your decision might have been influenced if the correction or if the information which is being misstated, if that misstatement was not present. Correct? So 10,000 rupees for Reliance Industries is not material, but 10 lakh rupees is material, or 20 lakh rupees is material. So how do you decide what is material and what is not material? An information, if it is influencing the user's decisions, an information, and that information's omission, the complete omission, the complete removal of that information, or misstatement in that information, a mistake in that information, if it is influencing the decision of the users, if it is influencing the economic decision of the users, then that will be called as material. Then that will be called as a material thing. Otherwise, it is immaterial. Otherwise, it is not material if it does not affect the economic decision of the users. Okay. So with this understanding, read significance first. What is the significance of materiality? Why are we seeing materiality? Financial statements which are materially misstated will not give a true and fair view. Right? You are checking for material misstatements. Misstatements which are not material are not important for you. Because misstatements, if they are immaterial, the financial statements will still give what? The financial statements will still give a true and fair view, because the misstatement itself is not material. Correct? Okay. So now read the definition of materiality on the left hand side. Read the definition. Read. Information is material if its omission or misstatement, that information's omission completely or misstatement, could either individually or in aggregate influence the economic decisions of the users taken on the basis of financial statements. Those decisions taken on the basis of financial statements. Right? That is when information is material. If it is influencing the decisions of the users. If it is influencing the decision of the users, then it is material. Okay. What do you do about this materiality when you are an auditor? Listen, what do you do about this materiality when you're an auditor? As an auditor, for every client separately, as an auditor, for every client separately, you will decide a materiality level. Listen very carefully. For every client that you have, you will decide what? You will decide a materiality level. For example, let's say I decided that for Reliance Industries, if I am the auditor of Reliance Industries, let's say I decided that for Reliance Industries, the materiality level is 1 lakh. Let's say I decided that for Reliance Industries, the materiality level is 1 lakh. I will tell you how do you decide that also. I will tell you how do you decide that materiality level, how that 1 lakh is calculated. But right now, assume that I've decided 1 lakh. What does it mean? It means that any amount below 1 lakh is not material. 90,000 mistake is not material. 80,000 mistake is not material. Any amount of mistake which is above 1 lakh, that will be material. Any amount of mistake which is above 1 lakh, that is going to be material. Right? So you decide a materiality level. As an auditor, you are going to decide a specific materiality level. All right. But in reality, what does the auditor do? The auditor sets a materiality level which is below the actual materiality. Let's say the auditor decided that the materiality level should be 1 lakh. Let's say the auditor decided that the materiality level should be 1 lakh. But in reality, they will keep the materiality level at 80,000 only. They know that above 1 lakh, the amount is material for this client, but the materiality level will be set at a lower limit at 80,000. That is called performance materiality. That is called performance materiality. And why is this done? In order to make sure that the smaller misstatements, when aggregated, which become material misstatements, those are not ignored or avoided. For example, let's say there were two mistakes, one of 90,000 and another of 95,000. In Reliance Industries, let's say there were two mistakes, one of 90,000, one of 95,000. Now, if I keep my materiality level at 1 lakh, I've decided 1 lakh, right? If I keep my materiality level at 1 lakh, these 90,000 and 95,000, I will ignore them. Since my materiality level is at 1 lakh, I'm going to ignore these two misstatements, which is 90,000 and 95,000. Correct? But 90,000 and 95,000 in aggregate, if you add both of them, it's a material misstatement. If you keep your materiality level at 80,000, if you keep it at a less than materiality level at 80,000, then these two misstatements of 90 and 95 will not be avoided, right? Will not be ignored. These two misstatements of 90,000 and 95,000 will not be ignored if you keep your materiality level at a lesser amount. So that's called performance materiality. Not very important from your exam perspective, performance materiality. You can just give one reading. Read what is performance materiality, right hand side. Read what is given as performance materiality. Not very important from your exam perspective, but still just once read. Let me know once you're done. Done? Okay. Now let's move to the last topic of today's, as to how do you decide that 1 lakh amount? I told you, right, that for Reliance, I'm taking the level at 1 lakh. So how do you decide that 1 lakh? How do you decide that materiality level? How do you determine that materiality? Materiality is determined either by size or by nature. Materiality is decided either by size or by nature. What do you mean by size? What do you mean by size? Let's see. See, materiality by size. You can decide that materiality level taking these percentages, taking these ranges. You can calculate 0.5% of revenue to 1% of revenue. You can calculate what is 0.5% of revenue. Let's say 0.5% of revenue is 1 lakh. And then you also calculate 1% of revenue. 1% of revenue will be 2 lakh. So you got a range 1 lakh to 2 lakh. You can decide any amount between that range as a materiality level. You can decide any amount between that range as a materiality level between 0.5% to 1% of revenue. Next, similarly, you can calculate 5% of profit before tax and 10% of profit before tax. Any amount between that can be taken as a materiality level. Any amount in between them can be taken as a materiality level. Similarly, you can calculate 1% of total assets, 2% of total assets. Again, any amount in between them can be taken as a materiality level. Or you can use two ranges. Let's say for the first range, which is 0.5% to 1% revenue, I told you, right? You got 1 lakh to 2 lakh as the range. Let's say for the second one, you got a range of 1,80,000 to 2,50,000. 1 lakh to 2 lakh was the first range. Second is 1,80,000 to 2,50,000. So what is matching in both? The range which is matching in both of them is 1,80,000 to 2 lakh, right? First one was giving 1 lakh to 2 lakh. Second one is giving 1,80,000 to 2,50,000. So the both of these ranges are matching at what range? At 1,80,000 to 2 lakh. So you can decide a materiality level between 1,80,000 to 2 lakh. In the exam, what do you have to do? In the exam, you just have to calculate the lower limits, guys. In the exam, what do you have to do? In the exam, just calculate the lower limits. Just calculate 0.5% of revenue, 5% of profit before tax, 1% of total assets. Just the lower limits. If the amount that is given is above the lower limit, it is material. Just calculate the lower limits. Revenue will be given to you in the exam. Just calculate 0.5% of revenue. If the misstatement which is given is greater than 0.5% of revenue, assume it is material. So basically, in the exam, just consider the lower limits. If the amount is greater than the lower limit, consider it as a material amount. Okay, clear? Materiality by nature, we will discuss that tomorrow. Materiality by nature, we will discuss that tomorrow. Or should we complete it? The materiality concept will get over. Should we complete materiality by nature also? We have 10 minutes, right? Should we complete materiality by nature? Say yes or no. Okay. Okay, let's see materiality by nature. Small topic only. Only we just have to see these bullets. Sometimes, irrespective of the amount, materiality by size is getting determined by amount, right? But for some items, irrespective of the amount involved, they are material. Irrespective of the amount. Even if the amount is, let's say, only 5,000, that will be a material thing because it is relating to one of these, one of these situations which are given in the bullets. Let's see what are they. First one, misstatement that affect compliance with regulatory requirement. If there's a misstatement, which is affecting, if there's an error or a fraud which is affecting compliance with any law. Regulatory requirement is what? Law. If it is affecting any compliance with law, then that's a material misstatement. For example, let's say there's a misstatement in income tax penalty. The company had paid a penalty for income tax, but they have not included that amount in the financial statements. That means there's a misstatement. An amount which should have been included is not included, and it is affecting the compliance with income tax law, with a regulatory requirement. Whatever be the amount of that penalty, even if that penalty is, let's say, only 5,000 rupees, it is a material thing. Why is it material? It is material because of its nature. It is not material because of its size. The size is very small. The size is only 5,000 or 10,000, but it is material because of its nature, because it is affecting the compliance of any law. Similarly, next, misstatements that affect compliance with debt covenants. What is debt covenants? Debt means loan. Covenants means terms and conditions. Covenants is what? Covenants is terms and condition. So if any misstatement is affecting any compliance with terms and conditions of a loan, again, that misstatement is a material thing. It is material because of its nature again, right? Because it is affecting the compliance with debt covenant. It is affecting the compliance. It is affecting compliance with the terms and conditions of a loan. Next, misstatements that when adjusted means what? Corrected. If that misstatement is corrected, it is turning a reported profit into loss. With that misstatement, with that mistake, the company was reporting a profit. But when you corrected that mistake, the company went into losses. So again, that misstatement, irrespective of the amount, will be a material misstatement. Why? Because it is converting a reported profit before correcting the misstatement to a loss when the misstatement is corrected, when this misstatement is adjusted. Similarly, next, misstatements that when adjusted turns a reported net asset position into net liability position. Before the misstatement is corrected, when the misstatement was present, there was a net asset position. Net asset position means what? Current asset greater than current liability. Net assets means current assets greater than current liability. That's a net asset position. Yeah. Now, what is net liability position? Current liability is greater than current assets. Current liabilities greater than current assets. So if that misstatements when corrected is turning a net asset position into net liability position, again, it's material. Next, any transaction with directors, like remuneration, salary, personal use of assets, any transaction with director is always material. And lastly, any disclosure in relation to going concern. Any disclosure in relation to going concern or relating to future claims are again material. Last one is about disclosures. So all of these are material by nature because of their nature. Their size might be very small, but they are material because of their nature, because their nature is so that they will be material. So remember what is material and what is not material. What is material? Anything which influences the economic decision of the users. That's called material. How will you decide what is material or not material? You can decide by size or by nature. For by size, remember the lower limits at least. All right. So this is where we complete the topic of materiality also. And we will end the class here because of course it's almost 12. It's 11:59. So I will see you in tomorrow's class again. Tomorrow again at 9 o'clock. And please study. Please revise whatever we have studied today. Your chapter 4 and chapter 5. Chapter 5 also almost like more than half of it we have covered. So please study chapter 4 and chapter 5. Chapter 5 half. And come back to tomorrow's class. and I will see you tomorrow at 9 o'clock. Bye bye. Thank you. You want to see the last slide? 1 second. Somebody wants to see the last slide. That's open now. 1 second. Thank you, guys.